What's up, guys? Today we're going to be answering an interesting question that a lot of people have, and that question is, can investing in the stock market make you rich? Can it make you millions of dollars? So today we're going to take a look at that, and we're going to start off with messing around with a compound calculator. Now, before we get into the very specifics of this, the first thing you got to realize, you have to learn kind of what a stock is, what is the stock market, how does it work, how risky is it, what are you actually investing into? And the stock market is, you can do more research on this, but the stock market is a place where companies trade shares of the company, and regular retail investors like me and you can buy those shares and trade those shares, and we can become part owners of all these companies, whether it's Apple, Amazon, Google, or whether it's a small new startup with only a $50 million market cap. So that's how the stock market works, and we're going to go through some statistics here to find out how rich can it really make you, and what is the likelihood that it makes you rich, and how long does it take. So we're going to start off, and let's say that we start off with $10,000 to invest, okay? And let's say we're going to try to invest $100 a month, okay? Let's say we do this for 5 years, and let's say the average, on average, the stock market gets about 10% a year. That's with dividends included. If you don't reinvest the dividends, it's 8%. So we're going to say 10% because we're going to reinvest the dividends. So that means that after we invest, we start with 10,000, we put in $100 a month, which is only $1,200 a year. With a 10% return, we will have $23,000 5 years later after we only invested $16,000. So that's a short time horizon, and it's not a ridiculously large amount of money, so that's very realistic. Now we're going to get a little bit more. First of all, let's say you do this for 30 years, okay? Let's say you do this for 30 years. You will have $371,000, and you only actually put in $46,000 of your own money, and you have $371,000. So that's the first step. The real value in this comes from the compound interest and letting the years go by of it stacking up. You can, maybe if you invest only for 3 years or 5 years, you can have some really good years and hit some big stocks and get where you triple your money or something. But the real value is going to come from investing over decades and having that money grow. Now let's say you start with $10,000, but now you're going to invest $1,000 a month for 30 years. Well, now you're going to have $2.1 million 30 years later after you invested $370,000. So $370,000 is about what you'll spend on maybe your house, right? Well, instead of investing in a house, you could invest all that money into an index fund like the S&P 500 or like the NASDAQ, and you'll have over $2.1 million 30 years later. Now, let's do something extreme. Let's say we start with $100,000, and we're going to invest $2,000 a month for 30 years. Now 30 years later, you'll have $5.6 million when you only contributed $820,000. Now let's roll this back a little bit. Let's say we start with 10,000 again, and let's say we throw in $500 a month for 30 years. But now this time, let's say that you are a very good investor and you can get 20% returns, okay? You're going to have a lot now. You're going to have $9.4 million after over 30 years when you only put in $190,000. So the time horizon and the interest you earn, those are the two most important factors. Now let's keep going. Let's look at, how do most millionaires get rich? Well, there's two types. There's a self-made millionaire, and then there's those that are born into wealth. So more than 2/3 of millionaires with over $30 million are considered, or more than 2/3 are considered self-made. So 66% are self-made, and this is saying that 33% is born into wealth. But I read the other day that it's actually about 21% is inherited their fortune. So that number might be different. Maybe it's because it's for 30 million and over. But we have that. Then if we take a look at the world's richest people, Elon Musk, Jeff Bezos, Warren Buffett, Bill Gates, all these guys either invested or started a business, right? So Elon Musk, for example, Tesla and SpaceX, mainly Tesla is what gave him all his money. And that's because he owns a large stake in Tesla stock. And Tesla stock went to over $1 trillion market cap, and he owns a huge chunk of it. If we look at someone like Jeff Bezos, it's the same story. A lot of these guys started business, and that's how it happens. But if we look at Warren Buffett is different, because Warren Buffett made his main fortune by investing. If we go to right here, we can see that Warren Buffett's net worth over the years, when he was 14 years old, he had $5,000. Now, $5,000 back then in the 1940s was actually a lot more than $5,000 today. But you can see he didn't become a millionaire until he was 30. But again, 30 or $1 million back then is a lot different than $1 million now. And then he didn't become a billionaire till age 56. But you can see how now he has over $100 billion now. That didn't happen until the last 10 or 20 years of his life. So that's why the compound interest thing is so important. If we go back now, here's another example of somebody who can make a lot of money when you own a lot of stock. In this case, it's more crypto based. But this guy, Sam Bankman-Fried, he had a $16 billion net worth just a couple of weeks ago. Now he's filing for bankruptcy because of FTX's problems they're having right now. That's another story. But you can lose money. Okay, you can lose money in here. But if you're smart and you play a little bit, you play it safe, you don't have to worry about that. Diversify your portfolio, buy a bunch of stocks, or just buy an index fund, and you don't have to worry about that. And the chances of you losing money are very low. If we look at, where's the chart? This chart. Here's all the reasons people say you should have sold stocks, right? You should say, oh, it's too dangerous to invest. Look at this, look at that. If we take Warren Buffett, for example, he's been investing since the 1940s. He invested through Pearl Harbor. He invested through World War II. He invested through the Civil Rights Movement. He invested through Vietnam War. He invested through crazy inflation in the 70s. He invested through all these different wars, 9/11, all these things that happened over the last 80 years. And look at, he's one of the richest people in the world. So, and here's a more recent one. And this is the last 10 years or so. And there's all these things that happened. There's, Trump becoming president. There's Biden becoming president. There's the China debate that we have. We have inflation now. There's all these different things. The bottom line is lots of things happen. The U.S. economy almost always recovers. There's bailouts. There's lots of people at risk of losing a lot if the stock market fails. If the stock market were to go down for like almost forever, for a long period of time, for 20 years or something, that would mess up everything. It's not realistic, because there's too many people invested and tied into it, where you can't have all these companies going bankrupt, all these people going bankrupt. It's not realistic. So you can do things like, I was looking earlier today, like on this website, you can look up what these people are doing. Anybody who's rich enough and invest millions of dollars, billions of dollars. It's a certain dollar amount, but the insiders of these big corporations, as well as the hedge funds and stuff, they all have to report what they're buying and selling. So you can check those things. And so there's ways to make it safer and make it so you don't have to worry about it. But yeah, this is the way it works. So thank you for watching, and I'll see you in the next video.